Hello, Adam.
Hi, Nick.
I like your hat.
Thank you. It has a circular logo with a B and an L in it. It stands for the Build a Bigger Life initiative. It's my book. I'm writing the Build a Bigger Life manifesto that's coming out in the next couple weeks.
Okay.
And we had a Build a Bigger Life retreat, and you can see that branding is very important to me. So I have a kick-ass branding woman by the name of Christine Bush, who we will introduce you all to on future episodes.
Yeah, she is awesome.
She is. She's designing a back tattoo for me right now. It's gonna be dope.
Super dope, super dope. Well, today we are talking about ideal banking accounts. We received a lot of questions and it's actually probably one of the most commonly asked questions that I get around, what type of account should I have? How many should I have? What do I need? What don't I need?
Right.
Because I'm hearing a lot of things like, oh, you need this and this and this, and I don't know what to trust.
Yep.
So today we're gonna debunk all of those.
We are.
And we're gonna talk about the things that that you really should be looking at in terms of like what it is that you need and what's really important.
Yeah.
So, do you want to just go on the list of what we have here?
Yeah.
Okay.
Yeah, let's do that. So I believe that what's interesting is all of these are somewhat personal stories.
Okay.
And then there's a lot of learning that comes through the personal story. So for me, I had multiple accounts for a number of years, and now I've consolidated pretty much into two financial institutions.
Yep.
One for business, one for personal.
Okay.
But I had a number of them at one point. I literally had probably 3 or 4 financial institutions personally, and another 2 from a business perspective. And the reason I did it was sort of non-intentionally. It was, I got an offer to open this account, which made it cheaper for me to pay for insurance, as an example. So I did that, and then money just slowly started funneling into that account, but I was still running them in multiple others. My one business account, I would drive to this bank in order to not cash checks, but deposit checks, in order to save 50 cents, because they charge 50 cents for every remote deposit capture. And at some point I realized this is stupid. I'm running around all these different organizations instead of all having it in one. So I started looking for some very specific things. So what we're going to do on this show is talk about what are the ideal accounts that everyone should have. So let's start with the most basic and simple, and that is a checking account.
Yeah, that's a check.
Yes,
yeah, checking account.
Checking account. So yeah, do tell.
Yeah, so for me, the checking account, really the way I think about it, this is where money flows into in the very, very beginning. From the checking account, there are different ways that I set up automatic transfers. But the checking is really where money flows in and out. And you can write unlimited checks from it. I personally do not write any checks. I'm good with Venmo, PayPal, and direct deposit.
Yeah, I guess I said checks, didn't I? I don't really write checks anymore either, but.
However, I do receive checks sometimes.
Yes.
And I'll use mobile deposit, so I don't have to pay 50 cents. But I remember at one point, I bank with East West Bank, and it was very interesting because I kind of got born into it. My parents had always had East West Bank and never knew anything different. So all my friends who had Chase, Bank of America, Wells Fargo, etc. They were like, what do you, and actually there was some embarrassment because it was like, why am I so different? I remember I opened up my checking account and got my first credit card there because, this was the one advantage. When I went to college, even though I had an East West card, certain banks like Chase, if you go to another ATM, they'll charge you a $3 transaction fee.
Right.
If you go to a Wells Fargo ATM. But with my East West, I could go to any ATM and they'll waive the fee. So it was part of like their perk.
Sure.
Because they were a smaller bank and stuff like that. But, number one thing is to have a checking. You definitely need, we talked about definitely a purpose around money, but you also need a place for money to go. So the checking is is one thing that you must have.
Yes. Now, the one thing I will add, you mentioned that they waive fees like ATM fees.
Yep.
Fee income, the fee revenue that a bank or a credit union makes, is their top line, most of the time, their top line money.
Wow.
So they're making more in fees a lot of times than they're making elsewhere. Or at least it's a significant chunk of their revenue. So if you are with a bank or a credit union and you have a checking account and you are being charged on a regular basis, you may be able to find a better deal elsewhere where you're not paying fees. And I think, having a checking account is very important. Making sure you're not paying, or you are paying the least amount of fees. You're not paying fees on it. That would be of high priority.
Yeah. Perfect.
All right, second account.
Second account is savings account. So, I know you have a story. It's like, the savings account is the put it in and then take it out, right?
Yes, it's neat. It's not a savings account. It's a put and take account.
Put and take account, yeah. We're not talking about that.
Put it in, take a little bit out. Put it in, take a little bit out. Yeah.
We're talking
Put it in, take a little out. Put it in and take it out.
We are talking about savings, which is put it in and leave it in. Personally, I recommend Ally Bank. Simply because it's very millennial friendly. It's an online bank, meaning there is no traditional brick and mortar store. You can't go to an Ally ATM or go to an Ally Bank, physical bank, and withdraw money. It is online, and a couple things. The reason why they're able to, or part of the benefit of being an online bank, is that they're able to offer higher interest rates. So when I put my money in Ally Bank, I think I'm getting 2 to 2.2% return on my money, versus a bigger traditional bank that might be 0.25%.
Yep.
So,
and the reason they can do that is it is an online bank, no brick and mortar locations and overhead and all that stuff.
Yep.
I tend to use something very similar. It's called Smarty Pig. We've talked about it on the show before. It's an Iowa company started by a local guy, eventually sold off to a major financial institution, but they also have higher than average returns. And it's very easy to transact business with them in terms of depositing and withdrawing money. So I like Smarty Pig in the way of savings accounts.
Yeah.
Now, one of the things that we've talked about this a little bit on other episodes as well, that idea of having multiple accounts that you're saving for. I think there is a level of sophistication that comes after you've had multiple savings accounts open, that eventually it's more about having a discretionary savings account as opposed to having the vacation fund, the car repair fund, the this fund, the that fund.
Yep.
And so, from my perspective, having one savings account for short-term savings is really important. And then having a longer-term savings account, which is really what I call the emergency fund or the opportunity fund, that's a little bit bigger amount. That's going to be for the third kind of account, which is a money market account. And a money market is just a savings account on steroids. So typically it's a little bit higher interest rate return. It might not be as accessible, like you may not be able to access it with an ATM card in some cases. But I like having that money market account because that's money that just sits on the sideline and it's there in case of an emergency. Some might call it the go to hell fund.
Go to hell fund.
Yes, because when everything goes to hell, the money's there.
Got it.
Yeah.
Got it. What else are there other things that you could use? I mean, you mentioned the term opportunity fund, right?
Yes.
I'm thinking about something I mentioned in previous episodes around the Wanderlust fund, right?
Yes.
Which is specifically for travel.
Right.
But what I like about the opportunity fund is that it's an opportunity, so it's not specific to something.
Correct.
But for example, if you had $5,000 in it, you could invest in the stock market if the market took a dip and you wanted to take advantage of the correction or whatever the case is.
You could buy real estate, you could buy a small business or buy into a small business, you could
start one.
Buy a camera and start a YouTube channel, whatever you want to do, right?
Hey!
So, I was going to go somewhere and then I decided not to. Anyway, so the third account is that money market account. So we have checking, we have savings, we have a money market, and then where do we go from there?
An account that you should definitely be taking advantage of is your company's 401k or 403b, depending if it's a nonprofit. But this is a qualified retirement account. This is the 401k. I think is like the tax code. That's how it got its name, right?
It is, yeah.
So the for people like myself, the common folk, right? The way to think about it is just the company's account that supports your retirement. So it's sponsored by a company, and this is, oftentimes companies will provide a match to your contributions, and so it really is free money that you need to be taking advantage of. Yeah. So if you're working somewhere, most likely they have a 401k or 403b option.
Yes. And what I found more often than not is people are typically either under investing in their 401k, or they are not investing. So they're under investing or not investing.
Yeah.
Under investing means if you get a 6% match to your salary, you're only putting in 3%. So you're missing out on 3% match.
Yeah.
Or they're not investing because they really need to make sure they have more in their paycheck than what they would have normally.
Yeah. I have a really quick story. I had a client of mine who, this is really interesting. She actually worked for a bank. She had a 401k and she had been working for 10 years. And when I started to examine her 401k statement, it kind of paid a lot of share. We realized that she was sitting in cash for 10 years. And it wasn't until I actually examined it and looked at, send me your statement just so I can see what it's invested in, because there's anywhere between 4 to maybe 10 options that a company will offer, as a fund. And she was sitting in cash thinking she was in a portfolio that was averaging like 9%.
Ouch.
Yeah. So talking about under investing or not investing, you also want to make sure it's invested the way you want it to be.
Wow.
So, yeah.
Boy, in one of the previous episodes, we talked about asking the right questions versus seeking answers.
Yep.
That would be a question to ask.
Yeah.
How am I invested in this 401k?
Yeah.
So we have 401ks for a for-profit company. A 403b would be an association, a university, a not-for-profit. But it's the same kind of vehicle. It's a qualified investment, meaning money goes in pre-tax, and then it's taxed when it comes out on the other side. Now, there is also something called a Roth 401k, and the Roth 401k, money goes in post-tax, and then when you pull it out down the road, it is tax-free. Yep. So there is definitely an argument to be made that our tax basis will only go up over time. Considering that there's $20 trillion in outstanding debt. It's probably 22 now. We'll have to do a show on that, the U.S. debt clock.
So that's a perfect segue into what's called a Roth IRA. So when I typically the clients that I work with, post college, like the recent college grads, definitely recommend that the Roth IRA is an account that you open and have, because there is an income phase out limit, meaning if you earn over a specific amount of dollars, and I think they raised it, but I think does it still start at 118,000?
Yes,
okay.
I believe it does, yes.
Yeah, so at 118,000, if you start to earn more, the amount that you can contribute to it decreases, and after a certain amount, it might be, don't quote me on this, 130,000 or something like that.
Yep.
You can no longer contribute. So my intention is that everyone listening and people, if you're below that, your income will only increase. So the Roth IRA is that much more important because you want to take advantage of it. And for those of you who are, above it, first of all, good news, that's awesome. You're high income.
Congrats.
And so that option may not be available to you, but if you should at least know whether or not you can contribute to it.
Yep.
So like Adam was saying, the way the Roth IRA works is that you're taking money that is post-tax, you get to invest it in a lot of different options that are available. It grows tax-free. There's no taxes on the year-over-year growth, and then when you take it out, it is also tax-free.
Yes.
So that's also important.
Did we miss any?
Well, I was going to say brokerage, but that's very similar to a money market account, right?
Yes and no.
Okay.
In my mind, the money market account that's money that's sitting on the sidelines. It's there for emergencies. It might be your opportunity fund.
Okay.
The brokerage account is for someone that's already fully funded their 401k, which I believe the number of this year is 14,500 or 15,000.
I think it was,
Or is it 17? Is it 19 this year?
18,000 was the max last year.
Okay.
So I think 18,500, 19. Maybe.
We'll double check that and put it in notes. But if it's, let's say it's 19,000 this year, you fully funded that. You fully funded your Roth IRA, which is
6,000 now.
Okay, $6,000. And you want to continue investing, you would then move it into a brokerage account. And a brokerage account allows you personally to go out and invest in the stock market, in mutual funds, bonds, etc. The brokerage account could be done really anywhere. E-Trade, Scottrade,
Charles Schwab,
right?
Trade.
Yeah, anywhere you want. In fact, you could also buy mutual funds directly from the provider. So if you went to like Franklin Templeton, or you went to American Funds, or what are the low cost? Vanguard funds. You could go to one of those companies and open a brokerage account and invest just like that. Every single month, $200 goes in, and you could dollar cost average invest and have DRIP, the dividend reinvestment program, where shares just continue to accumulate there as well. That would be a brokerage account.
Yeah, perfect.
Yes.
And we'll definitely cover in a future episode kind of how to do that. Because I do get questions like, okay, now I know what banking accounts I need.
Yep.
How do I do it?
Yep.
So to recap, the different accounts that we have a checking account, we've got the savings account, we've got the 401k/403b, we've got a Roth IRA, and a brokerage account.
Yeah.
And the opportunity fund.
And the opportunity fund.
That is my favorite. So
yeah, to wrap up the opportunity fund discussion real quick,
Yeah.
a friend of mine said one of the best things young people can do is put $5,000 in an account just to prove to themselves they can. Because what happens once the money goes in a qualified account, you can't get it back out again until you're 59 and a half. And what if an opportunity comes along? Might be nice to have $5,000 sitting there.
Yeah, and I actually remember when I was a financial planner, financial advisor, I kept on hearing people say qualified, non-qual, qualified, non-qual, and I was like, what is that? Clearly not qualified doesn't know what they're talking about. But qualified, you can think of qualified equals retirement money. Non-qualified is non-retirement money.
Yes.
Yeah.
Good distinction.
Yep.
So here's our challenge for you. At the end of the show, what we'd like to do is go out and look at all of the accounts you have and really detail what they are, what they're used for, and question whether or not you actually need them. Would it save you time and effort, energy, and possibly money if you consolidated accounts into the 4 or 5 accounts that we mentioned? Some people, their money just sort of spills out in all these buckets.
Yep.
And after a while, some people don't know where all of it went. So we want to make sure we're nice and consolidated, tight, you know exactly where the money's going, and we encourage you to do that at the end of the show.
Awesome.
Cool.
Sounds good.
Tomorrow is a That Just Happened episode, so be ready. We got some cool announcements.
See ya. Bye.